In this video, we're going to finish off the concept of, or the topic of capital structure with an attempt to identify the optimal capital structure, so the optimal balance or mix of equity and debt for a company. In the previous video, we walked through the Modigliani and Miller propositions, capital structure propositions, slowly getting sort of rid of those limiting assumptions, initial assumptions concerning the lack of corporate taxes and the lack of corporate, costs of financial distress. So let me say that now, in this video, we will be assuming that corporate taxes absolutely exist. And, that on its own, of course, from a capital structure point of view, means that there is a tax shield benefit or tax shield benefits associated with paying interest if a company is profitable. So that's good. There are also what we talked about at the very end of the previous video, the costs of financial distress, be they, the direct costs of bankruptcy or what happens even before bankruptcy finally hits, loss of employees, loss of clients, suppliers, trust, reputation, and that obviously has a negative impact on the business. So ultimately, on the one hand, having debt in your balance sheet does produce tax shield benefits, and we want to have as many of those or as much of that, but it also brings about costs of financial distress. So the solution cannot be let's take on 100% debt funding. There is a trade-off between the benefits and the costs. Those trade-offs are necessary, and ultimately what we will now use is a formula where the value of a levered company equals the value of one that is unlevered plus T, so this is a plus TD, that's the PV, that's the present value of those tax shield benefits. But we will also be making a deduction for the present value of all those costs, direct, indirect, explicit, implicit costs of financial distress. And I am going to, because your book does give this formula, I am going to write it down, but ultimately we won't really be able to find the, in a practical sense, the optimal level of debt. We'll just present this theoretically. The framework which we're using here has a name that you should know. It's called the static trade-off theory. Static trade-off theory of capital structure, and what it sort of says is that if resorting to the same graphical representation that we had before, so over here we've got firm value, right? Over here we've got the amount of debt which the company is using, and of course somewhere, let's say, is V0. This is the value of the company, V0, value of the business, of company, with no debt at all on its balance sheet. We said in a previous recording, right, that in the presence of corporate taxes, there's going to be that tax shield benefit associated with taking on additional debt. So this is sort of the value of the levered company equal to VU, what it would be. So VU is what the company would be worth without any debt, but on top of this, we're also adding the present value of the tax shield benefits. So over here, what I'm shading in green is that area. It's the PV of tax shield benefit, which is of course a positive thing. But at least from a certain point, not instantaneously, you also get sort of creeping in, let's say over here, a reducing factor. These are the costs of financial distress, and we're constantly thinking about the present value of them. And as you can see, they kind of reduce the value of the firm. So ultimately, you get where you end up with a line that I'm going to draw in black over here that kind of rises with the PV of the tax shield, but then starts to fall as the present value of the costs of financial distress becomes significant enough to dampen the value of the firm. And somewhere here, I guess you could identify a level of debt, let's call it the D star, right, which would be your optimal amount of debt, because it's with this amount of debt that the company achieves its maximum value. We maximize V, corporate value. In a practical sense, this is really impossible to calculate because we don't have the inputs. We don't know what the costs of financial distress, especially those indirect ones, are. It's much easier to estimate the tax shield benefits, but not the costs of financial distress. So we won't bother trying to find this. We'll say that in practice, what managers do is they typically try to establish what we call a target capital structure. And of course, when thinking about this target capital structure, they try to, that target is going to be based on managers' estimates of the tax shield benefit and the costs of financial distress, but also, certain internal and external factors that we discussed, I believe, 2 videos ago, which also impact the choice of funding and the amount of debt. Things like the stage of the company on the corporate life cycle sort of timeline. Right. Some important points that your book wants you to be aware of. So let me say here, important points, and list them. When you look at a company's actual capital structure, you may find that it is actually different to the optimal one or the target one. Now, some reasons why could be this could be the case. Well, sometimes the opportunity is good to take on additional debt. So sometimes management decide to exploit, for example, low levels of interest rates. Obviously, to take on more debt, to take on maybe more debt than optimal or planned or target, because you want to seize on that opportunity. Second, if you do this properly, like we are taught in corporate finance and the corporate issues section of the curriculum, you should be thinking of capital structure in terms of market values, and the market value, or the market values of both debt and equity, obviously change all the time, and therefore impact the relationship between D and E. And very also importantly, it would be impractical to really, for a company's point of view, to constantly try and realign to the target DE proportions, try to realign capital structure to the target debt to equity ratio. Why? Because every time you want to issue debt or borrow money or issue equity, that requires you to suffer various, transaction costs associated with, for example, launching an issue. So due to those, we don't do it all the time, which is why sometimes we are out of proportion or out of balance. And ultimately, what managers often do is they find it more sensible to use a range. So instead of saying things like, oh, we're going to have 30% of debt, 70% of equity, well, use a range like 25 to 35% debt, for example. Let's try to keep it within the range, rather than having a specific value that we would then need to stick to. Now, another important point, which you may get tested on, is that in practice or in real life, target capital structure is often expressed not using market values, but book values, or values coming from the financial statements. So is expressed using book values, financial reporting values for both the equity and debt component, of course, instead of the much preferred market values. Or at least what theory would suggest should be the right way to do it, using market values. And once again, I want you to know why this is the case. Well, first of all, using market values is a bit inconvenient for reasons that I've already mentioned. Market values of equity and of debt, they fluctuate all the time. So, substantially sometimes. So you'd constantly have a changing, let's say, actual capital structure. The second point is, although I find this one slightly sort of, I'm not sure if it really satisfies me, but your book mentions it, and that's what you should care about. Management actually care mainly about capital invested. So how the company, or what sources of capital the company uses when investing money, invested by the company, rather than how money is invested into the business, if you see what I mean, so not in the business. So the idea here is managers don't really think so much about, or shouldn't think so much about, how the company sources money from external investors, rather how it invests money, what it puts it into. Hence, this shouldn't be a big priority for them, although I don't buy this point, to be honest. The third one, although is I think quite sensible, using book values for equity and debt means you're using measures which are aligned, so alignment with measures and ratios that are used by pretty much everybody outside, so providers of debt and equity. I mean, if you go to a bank, or if you go to a fund or a rating agency, they typically focus on what's in your financial statements. So they typically focus at on book values rather than market values, and that's how they, external analysts measure your capital structure, not using market values. So you probably shouldn't be that worried about market values either if you're on the inside. Anyway, remember, this doesn't mean that when you get a question about, computing WACC or something like this, you should also use book values. By all means, if you can, if the data is given, use market values, not book values. These are just some practical reasons why, in real life, that's not always the case. Right. Another theory of capital structure that you need to know is very important. It's called the pecking order theory, and it's also related to the idea of agency costs, which we will talk about in a moment. So starting with pecking order theory. This is a theory which tries to explain why companies or why managers choose certain types of funding for the company, not on the basis of the cost of equity and the cost of debt or the tax shield benefit, etc. It tries to frame this, and it's a very nice theory. When I was a student, it was very popular a few decades ago, and I had a professor who was crazy about it. That's why I know it quite well, and I'm quite fond of it. Where on the one hand you've got the issuer, right, and on the other hand you've got investors. So obviously the issuer is the company, and inside the company are the management of it. And there's typically quite a lot of information asymmetry between the two groups. People on the inside, the management of the business over here, know a lot more about what truly happens at the business is going on than outside investors. And actually, outside investors should also always be a bit skeptical about what management are telling them. I mean, skepticism is what the pecking order theory is also kind of built on as a major premise. And investors should, in fact, require higher returns when the level of that asymmetry is high, because symmetry is nothing good. It means the company is very scant, for example, in telling you things about what's going on, sharing information with you. Then you should actually treat that as a warning sign. It's risk, and you should require a higher rate of return. Right. Nevertheless, management use this asymmetry, right, when seeking funding. When they seek funding, they use this asymmetry. And the pecking order theory, that name, if you're not a native sort of English speaker, pecking order means there is an order of preference with regard to what sources of funding managers typically use. So, first, if they can, managers use those methods of funding which require them to divulge as little information as possible outside. So they use methods of funding with what the book calls the lowest information content, in the sense of telling the outside world anything about the business. And those would naturally be sort of using internally generated funds. Because if you're using, the company's own internally generated funds, you generally don't have to tell anybody or anything, which is how management like it. Because management the whole theory is based on the idea that management want to keep this asymmetry because it's comfortable for them. Now, of course, the last choice, so that was the first choice, but the last choice would therefore be a method of obtaining funding that causes or forces management to divulge the biggest or the maximum amount of information. So here, last choice would be methods with, I guess, the highest or most information content. And this would typically be something like an IPO, a public offering of shares, where you really have to pretty much say everything you can about the company in the prospectus during the roadshow, etc. Obviously, in between these two, there is also the issuance of private debt. There's also, public debt, typically involving less information than issuing shares in the public markets. Now, the important thing is the actual choice of funding method, sends signals to the outside world. So when a company or when a company's management decides to do this, issue shares in the public market, investors should probably interpret this as a negative signal. Now, so this is like a warning sign. Why? Because using this method signals that the other options are not available. Obviously, this theory ignores the fact that there may be an optimal capital structure which involves both debt and equity. Now, if you go for equity, kind of the theory is, this is a negative signal because this is the least natural way for management to fund the business. What is more, and this kind of confirms the negativity of the signal, is that typically managers decide to issue new shares when they believe that the share price is good, that they can get a good price for the newly issued shares. So when they believe the stock of the company is actually overpriced. So for a potential investor, this means it's not necessarily the right moment to be involved, because if it wasn't overvalued, why would the company want to issue additional shares? That wouldn't make sense. So as you can see, there's a lot of skepticism built into this approach, and that's why it's quite interesting, because it's trying to explain funding choices, more sort of behaviorally in terms of a game between management and investors, and this idea of informational asymmetry. Another point is, if we're issuing additional shares to new investors, why do the existing owners want to sell to new owners part of their business? That raises some questions. I mean, I know there could be a perfectly valid explanation for this, but maybe it's because they believe the business is overpriced or the business isn't that good. And anyway, we know that equity, issuing shares, taking on equity, this is the most expensive funding source. So why resort to the most expensive funding source instead of using some of the cheaper ones, like taking on debt? Maybe they're not viable, or maybe it's the company doesn't have internal funding, which means it's in a pretty tight spot. Now, contrary to this, let's think about what a positive signal would be under this approach, or under this framework, under this theory. A positive signal would, for example, be the issuance of debt. Why? Because it means that the management of the business feels confident in the company's ability, or has confidence in the company's ability to make the scheduled payments. If they don't go for debt funding, omit this these steps which are higher up in the pecking order in the hierarchy, and go for equity funding, it may signal, that they don't believe they would be able to support debt payments. Once again, sort of confirming that issuing equity should be, or may be, interpreted as a negative signal. I think it's a very, very it's a very attractive approach. It's definitely different. It's a different approach to thinking about funding choices. And let me just say a few words about the notion of agency costs here, right? Agency costs are those incremental additional costs that arise from the conflict, sort of the corporate governance conflict or struggle between managers, shareholders, and of course providers of debt funding, so bondholders and I guess banks as well. Now, in a theory or a hypothesis called the free cash flow hypothesis, Michael Jensen, who you will know from, for example, from Jensen's Alpha, which we also study within portfolio management, hypothesized that a high level of debt, so a high level of leverage at a company, is a positive thing. It's a good thing. It's a positive sign. Why? Because having a lot of debt means the management has less freedom, first of all, to take on more debt, or spend cash in an unwisely. You have to constantly budget everything. So having debt means you have to be disciplined in your spending and your additional needs. People will not necessarily lend you additional money, and you have to govern with what you've got in a wise way. That's why having leverage is a good thing.